Welcome to another episode of the Strive for 25 podcast. Joel Farrell, your host here. And I posted on Twitter yesterday and had a lot of messages come in about the ways to be able to scale a portfolio using residential lending. And so I want to take some time to just kind of go through just some of the array of lending products that are out there. So if you're an aspiring investor or an investor that is in the middle of your journey, knowing what types of tools and products are out there to be able to help navigate, because we know this stuff. And when we're having a conversation with somebody and we just start to go through the different things, it may be a lot to absorb at one time. But this just gives you a little bit of a foundation to know what's available out there from a residential side, a commercial lending side, and also kind of this other lending tools that we'll get into in just a second. So the post that I made yesterday, hey, what if you could buy 3 houses for $1 million in 24 months with 0 down? And if you've purchased a home before, first off, a 0 down loan, there are not a lot of options out there. There are down payment programs out there, but they typically require you to live in the property for a number of years. There are some other loans out there. USDA is a rural loan, but the requirements are tight to fit into in terms of income and also the geography. So how does this work? Well, I'm going to dig into this in just a second. What I want to do is really just dig into the blueprint here of the actual options. So you have your primary residence loans and you've got your investment property loans. So I'll start with the primary residence loans. The basic 3 that I have on here is FHA, which is a 3.5% down payment loan, conventional, which is a 5% down loan, and your VA loan for military is a zero down loan. And so if someone is trying to scale and build a portfolio, how does this fit together? Well, the people that are out there, there's a guy by the name of Julian Gordon, who is a multifamily guru, and he believes in multifamily as a way to be able to build wealth and build generational wealth if you know the formula. And, the FHA loan, real quick, 3.5% down. And if you want to purchase a 2-family, a 4-family, a 3-family, you're still putting 3.5% down because you're going to be living in one of the units and you're saying you're going to live in the unit for 12 months. And then from there, things can redirect and you can go into a different direction and possibly live somewhere else or even buy into the next property if you can qualify. So in terms of context, if I come down here to the conventional loan as an investment property, if you want to purchase a 2 to 4 unit as an investment property, you're putting 25% down. And then on a conventional loan, you need to put, as even if you're going to live in the property, you're going to have to require more money down unless you fit into certain other programs with income guidelines, which not for this discussion, maybe a different discussion. But the basic premise is, hey, on an investment property, you're putting more money down. On a multifamily, you're putting 25% down as an investor. So to be able to put down 3.5% is a major win in terms of just minimizing your cash outlay and opens up the barrier to entry to more people. So that 4-family property, you live in one unit and you rent out the other properties. I'm actually going to just take a quick scenario and just read it out loud to you. So this is a 4-family in St. Louis, Missouri, in the Southampton bridge, right there off of Chippewa. It's a 4-bed, 4-bath, 3,400 square foot building. These are shotgun style, so 1 bed, 1 bath each. And it's listed at $310,000. It's 5056 Chippewa Street in St. Louis. So these are going to get probably $600, $650 or so in rent. And so this program through MBS Highway spits out $2,465 in monthly rent from the program, which is actually pretty accurate. And when you take into account some of the other details, property taxes, $2,400, monthly insurance, $100 a month roughly, monthly home maintenance, I put in $400 a month, property management 8%. And it does this program with MBS Highway does take into account a lot of different factors. It maps out a 10-year horizon in terms of the value that you build in terms of equity and mortgage pay down and values going up and cash flow. So all these factors coming into play. Again, cash flow, values going up, which is appreciation, the mortgage balance getting paid down. So the way that this is set up is as an investor loan, putting 25% down. So monthly cash flow in year one is actually a negative $108. And then you start to turn positive in year three. And over a 10-year horizon, your total gain is $202,000. $202,000. And you put in initially $77,000 up front as an investor. So your average annual rate of return is 13%. And then your return on investment is 260%. So you're more than tripling your money. So how does this compare back to this FHA scenario of 3.5%? So if someone was going to purchase this property as a primary residence, and we're going to put down a 3.5%. So that also means as I'm doing this transaction, and updating the data, that means you have to live there for a year. And that scenario for rate on the previous one I had in the mid sevens as an investor, rates for FHA are going to be probably in the fives right now, upper fives. So there is monthly PMI. And so your cash outlay is, instead of being $77,000, your cash outlay is going to be quite different. And so just doing some quick math here. So the loan amount is going to be about $300,000. So your cash outlay at closing, you're talking, $10,000-$15,000 or so. So quite different cash flow, cash in. Now the monthly cash flow is obviously going to be lower because your mortgage balance is going to be higher and your payment's going to be higher. But this is where you're living for a year. And so this analysis assumes that all these properties are rented out. So for just complete sake of simplicity, I'm going to leave this the way that it is. And after a year, you move out and this becomes a full-time rental. You're talking about the total profit being $175,000 over a 10-year period. We'll call it a 9-year period after you turn it into a full-time rental, or we'll call it an 11-year period, so to speak. So you put $15,000 in roughly. I'm rounding up to $15,000 with closing costs in here, and $15,000 into $175,000. So return on investment is 1,700%. 1,700%. So you're talking 175,000 and you put in 15,000, you're basically timesing your money by $11,000 in terms of your investment. That you don't get that in the stock market. You don't get that into normal investments. This is definitely what we call an alternative investment. So I want to go back to these other scenarios. So we just went through FHA, right? 3.5% down. You buy as a multifamily. What does that mean for the long term? Potentially, they'll be able to turn it into a full-time rental after a couple of years, rent out the previous unit, and have the cash flow come in, appreciation, and mortgage balance pay down. So again, your conventional loan is a 5% down loan for a primary residence on a single unit. And what's unique about VA is similar to FHA in that you can use it to purchase multifamilies. And the county limits for multifamilies is higher. So that's for a different conversation. But that can be powerful as well. And so I'm going to come back to this VA scenario as a primary residence later. I'm going to kind of finish this outline of the different types of lending products. So again, if you're doing a residential conventional loan and you're buying an investment property, 15% down is your minimum, but you are going to have PMI. 20% down is kind of your standard. And then 25% down actually is a major threshold for pricing in terms of the rates being better. So 15%, 20%, 25%, each of those is going to have different levels of rates and rate adjustments. And then multi-unit, you're talking 25% down, and obviously no PMI. And so each of those loans, you're going to have to qualify on debt to income ratios. And each of these types of loans has different guidelines in terms of if you have previous rental properties, tax returns and leases. So on conventional loans, you can use a lease to offset a previous home that's becoming a rental. So if you don't have rental property income on your tax returns, then you can use a lease to offset the payment to be able to use it for qualifying. FHA, for example, a home that you're departing that was a primary residence, now you're leaving it and turning into rental. FHA does not allow us to use leases. It has to be a rental property for a number of years and on your returns. So that does affect qualifying. And one of the biggest things is that you're going to have to source funds for down payment. You can't use borrowed funds. And now when you get into the commercial side of things, it's a different entity that's providing the loans. It's a different type of loan. So these are going to be loans that are going to be lended to you as a borrower in your own LLC versus, in your personal name for residential loans. And so the traditional commercial product is a 5-year balloon, 20-year amortization. Whereas on the lending side for residential, your traditional product is a 30-year fixed. Not going to change. But in this product, the loan comes due every 5 years. So you have to refinance and restructure. And that was actually one of the things that happened in the 08-09 recession is that values came down so much and the collateral for these loans adjusted and shifted down. And so when these loans were coming due, they were not able to renew some of these loans on the commercial side because the collateral came down. They could only lend off of a lower dollar amount. And so property owners that didn't have the cash to put in to reduce the loan amount, defaulted on their loans. So that's just one thing to be aware of. The other product, if you have a track record and a history, then you're going to be able to open up other options like a line of credit. I've got a line of credit on a couple of buildings with a couple of local banks. And so it can draw down on it, use it, and then pay down along the way. And then as I pay down and open up the line availability, I can use it down the road if I need to, if I wanted to be able to use it for other purposes. So your traditional banks, your local banks, your Chases, your Wells Fargo, Citi, PNC, Busey Bank is a local bank. I mean, those are going to be your some of the names out there. Every area, SunTrust is one, Truist is another one. There's a lot of commercial banks out there. Now you've got kind of this other alternative type of lending that's out there as well. And, you probably have heard the term hard money, right? So on a spectrum, you're going to have your commercial bank kind of being the best rate possible. Your hard money is going to be the highest rates out, the higher rates out there. And there are higher rates because there's less track record, less of a strong profile in terms of track record and credit scores or even cash in the deal. And so they're going to be higher rates, more costs at closing. And, those types of deals, you have to get a really, really good deal on a property to be able to make those numbers work. Now, you kind of have this middle ground, and I call it private investor money, private investor companies, and Share States, Lima One Energy. These are a couple of the companies that are out there that do this private money, and they're accessing capital kind of in a different market with some of the Goldman Sachs's, some of the higher end banks that are out there. And so this is kind of an alternative way to access commercial funding. So there are 30-year fixed products in this platform. Now they are higher rates than what you would get on your traditional commercial bank. You have a bridge loan, which is really kind of a different way to be able to say, hey, this is a short-term 1 year, 2 year type of loan, interest only, rates are going to be a little bit higher, and you can get into a property, do some work to it, transition it, upgrade it, stabilize rents, and then be able to refinance in a couple of years into more of a traditional type of product. Then this also kind of leads into the fix and flip, which is also kind of a bridge loan type of thing too, where, hey, I'm going to put 20% down, maybe 25% down, and then the lending institution is going to provide funding for upgrades or renovations. And, at one point in time, there were companies that would lend 100% of the renovations. So let's say you buy a property for 100 grand, you put down 20%, and your renovations are going to be $50,000. So basically, you put in $20,000, and then they're lending the $50,000 to you along the way to be able to upgrade the property. Now, it does require more of a percentage down in terms of the upgrades, the renovations. So sometimes they want 10%, 20% of the upgrades. The total amount of upgrades, 10, 20% down additional. So that's a fix and flip loan. And again, these are investor loans. These are going to be done in an LLC. So these are just kind of the basics on some of the investor loans. And again, this is going to be a very quick episode here. I do want to come back to this VA scenario because it's something that some people aren't aware about. But if you're in the military, if you're retired veteran, the VA loan is powerful. Now, at the same time, a VA loan also has risk to it because you're putting zero down. And, for somebody that, is their first time or second time using a VA loan and is not retired and getting disability, you're going to have a VA funding fee. And so that puts you into a negative equity situation. So your funding fee on first time usage is 2.3%. So if you buy a house for $100,000, put zero down, your loan amount is going to be $102,000 and change. So you're starting out with the mortgage balance higher than the value of the house. So there are risks to be aware of that. Hey, if you can't pay your bills, if you're short on being able to make your house payment, being able to sell it in the first 2, 3, 4, 5 years, could be a problem depending on which way values go. So always important to be able to know what your budget is, knowing how your finances are working in terms of being able to save, build your emergency funds up for the rainy day. 6 months of reserves is kind of your blueprint for your standard to be able to cover all your expenses. But once you bypass all those kind of thresholds, and you're able to start to scale and build and acquire more properties, that's where things get interesting. So on Twitter, I mapped out this scenario, and I'll just paraphrase. So let's say you've got somebody active duty. Let's say that, and the example that I gave was somebody in Virginia Beach, right? Southern part of Virginia, where the county limits in most of the country are 726,000 and change. So the county limit, 726K. In the DC market, the county limit is much higher, and I'll share more about that in a second. So let's say you buy, a veteran who's married, has a kid, they buy a home that's, let's just say it's, 3 beds, 2 beds, whatever it is, for $200,000, no problem. They qualify, zero money down, good to go. And in my post, I mentioned in 24 months. So in the previous note, I mentioned, hey, you have to live in the property for at least 12 months. That's the requirement if you're going to buy it as a primary residence. And so in this scenario, how do you buy 3 in 24 months? Again, I'll get into this. So let's just say January 2021 rolls around, you buy a house, 3 bed, 2 bath for $200K. And all of a sudden, later in 2021, you find out news that your wife and yourself are going to be having a baby in 2023. So life is changing. But hey, you know what? We're going to wait till the new year rolls around and we're going to purchase a new home. So you fit the requirements of 12 months, no big deal. And so you buy a 4 bed, 3 bath home for a slightly higher price. And in this example, what did we say? We said 200K. And then I think 270K is what we did. Let me see here. Okay, we said 280K. Okay. $280,000. So, okay, no big deal. We qualify on income ratios. We get a lease. Underwriting allows us to use a lease on the old property to qualify. That's a whole nother story. But we buy this property for 280, zero down. We're good to go. And so you have total financing out there for $480,000. And then the end of 2022 rolls around and you get news that you're going to be PCSing to Northern Virginia at the Pentagon, Quantico, maybe Andrews Air Force Base, somewhere in that area. And so now you want to buy a new property in the new duty station. Again, for those out there that don't know what PCSing means, it's basically just relocation. So in that scenario, how can you use another VA loan? Because the rule of thumb out there is that you can only have one VA loan at a time. Well, it all comes down to entitlement. And the simplest way to explain this is kind of a backwards way. And this isn't the way that the VA calculates it, but this is the simplest way because it's all about VA entitlement. And the VA guarantees 25% of a loan. So in this scenario, the county limit for 2022 was just over $646,000. So if you take that second loan that we did for 200,000 plus 280, that totals 480. So we're still below the county limit of 646. So cool. So 480 of 646, that's only what is that? A couple $100,000 difference. And then now we're going to go into 2023 and then we're going to buy a home that's going to be close to $600,000 to get us to $1 million. And we're going to be able to do that with zero down. How is that possible? Well, two things. One, Northern Virginia, the DC area, it's a high cost area. It's high cost, meaning that the county limit in 2022 is actually $970,000, I do believe, change. So you can purchase a home with a conventional loan, 5% down, FHA loan, 3.5% down, VA loan, 0 down. Now the VA, if you have no loans out there, the VA allows you to go to technically unlimited number of price point. You can go to $1 million, $2 million with 0 down. The VA has no restrictions on that if you have no loans out there. But lenders will have restrictions on how much they'll go to in terms of total loan amount. So back to the scenario. So 646 is the county limit for the country in 2022. The high cost limit in the DC area was 970. Now, there's other areas out there like LA County is one example. That's a high cost area that's similar. So going into 2023, these levels shifted as prices have gone up across the country. So the national number is $726,000 and change. And then now the high cost limit in the DC market is 1.089, I think is what it is, 1.089 and 300. So that's shifting that threshold up that we can maybe purchase on a VA loan and have 0 down. So I'm going to do just some backwards math on this. So 1.089 minus the 200,000 minus the 280. So technically that puts us at around 609,000 roughly of purchase power using a VA loan with 0 down. And so for this scenario that I mapped out on Twitter, this is actually what they did. They purchased a $600,000 home, 4-bed, 3-bath, and they did it in Springfield, Virginia, which is a little bit further out from DC, out I-95. And that price range fits for them. And now they have 2 rental properties that they're going to hold for the long term with low interest rates because they purchased in 21 and the beginning of 2022. So Alexandria, Arlington, are a couple areas that are very, very expensive. If you want to buy a 3-bed, 2-bath home, you're talking probably $700,000, give or take range. And those the DC market, the prices are high, right? And the way that I try to explain this, and I'll use this just in my own hometown, there's a couple pockets of areas that are very, very expensive. Here in St. Louis, you have Clayton, you have Ladue, Kirkwood's also a pretty high priced area. And so $1 million for a home in these areas, is very different than, that home in Clayton, right? That's 2,500 square feet, maybe it's $1 million in 20 miles west in a different city or municipality. Maybe it's a $400,000 house or a $300,000 house. Very, very much different in terms of the prices because of the geography and the demand for wanting to be in these centrally located areas and good school districts. Clayton has a downtown area that has a lot of corporate dollars that come in as well. So take that Clayton, take that Ladue, and in comparison to the DC market, and imagine that high priced area throughout the entire metro area. Let's just say of St. Louis. So, you got St. Louis City, you've got the county inside of 270, and then you've got some of the outside counties or cities that are outside of 270, and St. Charles and St. Peter's and Baldwin and Arnold and beyond. And so imagine that entire metro area, to buy a single family house, 3-bed, 2-bath, 1,800 square feet. Imagine paying $700,000, $800,000 for that house when you're 30 miles outside of the city center. So that's just a kind of a rough example of how these high cost areas work in terms of just trying to relate it to. So we're going to end the episode here. This just gives you a very quick rundown on some of the lending products that are out there, how they work together. We did provide a quick scenario on VA and how to scale using a VA loan. Again, there's a lot of details that go into this that we didn't get through that matter in terms of the risk and reward and assumptions that go into it. So if you have questions on this, let us know. We can get, obviously on the lending side, we do this. There are all other lenders that we know too that we can help guide you to. But take care and have a great rest of your day.